Good morning and welcome to this Monday, October 4th, 2021 edition of Trading Places Live at earningsbeats.com. I'm Tom Bowley, Chief Market Strategist here at Earnings Beats, and I'll be your host for the next 30 minutes, featuring everything you need to know as you prepare for the trading day ahead. Well, currently, let's see, we've got futures down a bit this morning. Of course, it's Monday. Monday tends to be a weekday, although it's the second trading day of October. And as I pointed out in the daily market reports last week, the strongest days of the calendar month in the stock market historically are the last trading day of a calendar month and then the first and second trading days of the next calendar month. So this is part of a typically bullish period. We do tend to start out October pretty strong, at least on the S&P 500. But this morning, we are seeing futures down a little bit. They're off their worst levels of the morning. Dow Jones currently down 3 points, S&P down 3 points, NASDAQ down 29 points. And that was as of about 8 or 10 minutes ago. So I don't know, that maybe they've improved further at this point. Crude oil is up about, I don't know, $0.50 per barrel, up over $76 a barrel now. And if you recall, that $76, $77 area was an area of key resistance. So that's worth noting. U.S. 10-year Treasury yield down today. Treasury price is down. The yield actually up about 2 basis points, up to about 1.49%. So that's how we're going to start the week. We'll see how things progress. Of course, we've been in a downtrend. We're going to talk about that a little bit. Some of the things maybe to look for in what's referred to as an ABC corrective kind of period. When the market just consolidates and moves lower. I don't think this is going to last to the downside. As most of you probably know, I'm pretty bullish the market, and for a lot of good reasons, technically, which is what I follow. I like to look at the charts and listen to what the charts are telling me. So I've got a couple of charts I'm going to show you. I think that also will point out, a couple of reasons why I remain pretty bullish. All right, but let's go ahead and get this thing started. Let me first, for those of you who are new, I'm going to take you over to Earnings Beats, where if you'd like to learn a little bit more about us and what we do, you can scroll down. We have a free Earnings Beats Digest newsletter. All you need is name, email address. There's no credit card required. It's out 3 times a week, Mondays, Wednesdays, and Fridays. This morning, I put an article out. I probably got out a little bit late, which was my fault. I wrote it a little bit late, but it was on Tesla and the fact that Tesla tends to have really solid pre-earnings moves to the upside. I've written about it before in my blogs at Stock Charts. And, here we are just a couple of weeks, a little bit more than 2 weeks away from Tesla's earnings. Over the weekend, they announced that they had exceeded their expected deliveries for the last quarter, even though many of the other automakers were falling short of targets with the chip shortage. It's been difficult for many of these automakers to get their orders shipped. But Tesla, kind of a different breed, and they announced stronger than expected deliveries over the last quarter, and stock was up almost 3% pre-market this morning. So we'll see how Tesla does today. But just know that this is a company that has a history of running higher into its earnings report. And, those types of things are important to know because a lot of folks will wait and see what the earnings do. At that point, a lot of times with Tesla, it's too late. So anyhow, the Earnings Beats Digest is a great way to get to know us if you don't already. Again, no credit card required. You can unsubscribe at any time. You won't hurt my feelings a bit. We try to make it educational. We focus on a lot of the things that are important to us at Earnings Beats, relative strength earnings, those types of things, candlesticks, reversals. I think you'll enjoy it. If you want to give us a shot with our paid service, there is a no-cost 30-day trial. The only difference is you have to provide a credit card so we can get you set up in our system and get it, all the tools and features sent to you. But we'd love to have you give us a shot. Let's take a look at what happened on Friday to close out the week. We did rebound pretty nicely, which was nice. The Dow Jones Industrial Average up 482 points. And you can see the Dow had gotten down into this zone around 33,500 up to 34,000, which is where we've seen a lot of reversals. We saw it again on Friday. The S&P 500 down, or excuse me, up 49.50 points. That's up a little bit more than 1%. NASDAQ was up 118 points, which was up less than 1%, about 0.8%. So you can see that the safer indexes, if you will, actually performed better. We had the Dow 1.4%, S&P 1.15%, and then the NASDAQ 0.8%. But small caps and mid caps, you can see, did very well. Mid caps up 1.6%, small caps 1.9%, but still both trading in range. And right now, the market's not at all-time highs. We're going through a period of consolidation. We're just coming out of September. September historically is the worst month of the year. So I don't think what happened in September was anything unusual. We don't always go down in September, and the market looked pretty good heading into September as far as I was concerned. So I was a little bit surprised technically, but seasonally, historically, not surprised at all. If you do study history and you know about history, September is the worst month of the year historically, dating back to 1950 on the S&P 500. Looking at the sectors, all the sectors were higher. I think maybe utilities was flat. The others were all up at least a little bit, but energy was the leader, up 3.3%. As I mentioned at the open, we've got crude oil prices up, challenging multi-year highs. We're going to take a look at a chart on that a bit. But energy doing very well. Still got to negotiate $55, $56 to the upside. If it can do that and crude oil breaks through 77 or so, that combination, no doubt energy could run. I'm not banking on it because I still think the dollar will be strong. And if crude oil doesn't break out and the dollar is strong, I don't see energy outperforming. But if we get the breakouts that I just talked about, then sure, energy could absolutely outperform. Communication services up 1.7%. So less than half or about one half of the energy gain, but it's coming at a good time. I mean, we had been moving lower. We had broken below the moving averages. You can see the volumes picked up. On our last rebound, we failed at the 20 with futures this morning down a little bit. The XLC probably is going to look to at least test those recent lows. And now with the price action below the 20-day moving, which is our moving average, which is below the 50-day moving average, we've got a bearish configuration short term. A lot of folks say, oh, we're about below the 50-day moving average. That's awful. Well, it's not awful. It's consolidation. Can't go up all the time. You can't go up every week of every month of every year. I mean, at some point, you've got to pull back and have periods of consolidation. And I think that's what we're having right now. Financials, excuse me, triple top up near 39. Couldn't get that breakout. Pulling back, but we did come back up on Friday, bouncing off the 50-day. We were up, like I said, 1.6%. So a nice day for the financials. Of course, financials doing well because the 10-year Treasury yield has been moving higher. Anytime we start trending higher on the 10-year Treasury yield, financials tend to outperform the rest of the market. So while everything else was dropping in September, you can see, and financials were dropping until we saw the 10-year Treasury yield start to move up, and then we rebounded strongly in that group. Materials threatening some key support down close to $78, but we did bounce off of it on Friday, getting back up slightly above 80, but very much like communication services where we're trending below the 20, which is below the 50. You can see that same configuration here with materials. Moving down, bouncing, failing to hold the 20, or failing to break through the 20, I should say, and then rolling back over again. A break below 78 would be bearish here for materials. Technology also faltering in the near term. September, as we went into September, technology looked pretty good. Coming out of September, looks a little bearish. Got that death cross with the 20-day below the 50. So we'll see what happens. One of the things I'll be watching if we do continue to go lower, watch the AD lines. Let's see if the market finishes weak at the end of each day, because that to me is more of a sign of distribution. And that's the way it works with the AD line. That's how this line goes down. If you're finishing toward the bottom of your trading range for the day, then the volume, that wherever you finish during the day relative to your high and low, that's your multiplier times the volume. So if you finish right on your low of the day, whatever the volume is that day is going to get subtracted from the AD line. If you finish right on the high, whatever the volume is that day is going to get added. If you finish in the middle, there's going to be no change. If you finish slightly below the middle, then you'll have a it'll be a fractional piece of the volume that'll be subtracted. So understanding how that works, anytime you see the AD line, starting to roll over, then there is a sign of some distribution taking place. And the AD line is not going to go up every day all the time. You're going to see periods where it pulls back. Some are going to look better than others. I mean, energy, which looks as good as any area of the market right now. I mean, look at the AD line. AD line's not confirming this move to the upside. Communication services was at a high, and as it's been rolling over, you can see the AD line's been going with it, partly because that volume has been so strong. When it finishes near a low, it goes down much quicker than when it goes up because the volume wasn't as strong. So all of that plays a factor, which is why I prefer the AD line over the OBV. I just think it kind of, I don't know what the right word is, but I just feel like it paints a better picture for what's actually transpiring, in the stock market. Let's go ahead and move on. Talk a little bit about the 10-year Treasury yield to give you an update here. So right now we are up almost 3 basis points now, 1.493%. And this move to the upside, you can see the financials relative to the S&P 500 moving higher when we get this pop. You see this pop here in the yields, financials move higher. So as long as you've got yields moving up, and you can see it over here when we made this big move, financials moving higher. That's one of the staples when you start looking at intermarket relationships. When folks are selling bonds, they tend to move into financial stocks. Selling bonds sends the yields higher. Yields moving higher tends to increase net interest margins of banks and there are other industries that kind of mirror that action in banks, especially life insurance companies. So those two areas in particular do very well when yields are moving up. So I think yields are going to move up. I don't think yields are going to soar. I think we have a chance to go back up, maybe test this 175 area. I think a lot of this is going to depend on what the Fed decides in terms of when they're, going to hike. They've now talked about moving it up into 2022 when previously it had been 2023. So depending on, what they decide, I think that's going to dictate which way we see the yields go here in the near term. But I could see definitely 170, 175 being tested again. But then maybe more consolidation, especially if inflation does begin to tame more quickly than even the Fed might expect. We could see yields move right back down and just stay in this range. So, if there's no inflation, if you've got growth and the growth is really strong, the reason the Fed raises is because they want to try and stay ahead of inflation. So you always want to try and, raise so that the economy doesn't overheat too fast. Well, if they're not seeing signs of inflation, I'm talking about, another 3-6 months from now, if the economy is strong, but they're not seeing signs of inflation, they're not going to raise, in my opinion. It'll be a while. So that's what could keep rates low. Anyhow, that's the 10-year Treasury yield, where we stand there. So let's move on over to, well, before we move to talking technically, I would just point out August factory orders will be out later this morning. I think they come out at 10 a.m. They're expected to rise 1 full percent. That's the estimate. July rose 0.4%. So we're expecting factory orders to pick up for the month of August. So that'll be out later this morning. All right, talking technically. So let's look at the S&P 500. And when you look at this, I see like an ABC correction here, depending on where you want to draw your lines. But I see one move down, a bounce, and then a second move down. And then we start moving higher again. Looking for others on here. Don't really see it. It's just more extended. Like here we pull back, but it's just one time. This isn't an ABC because the C doesn't go below the low on the A. So you get A down, B up. This would have been a C, but we didn't put in a lower low. We went down, tested low, and then just moved higher. So I don't really see anything anywhere in here, but anytime you get a move down and then a move back up and then a move to a lower point, that's an A, B, C correction. Now, we don't know for sure that it's not going to continue the downside. It's an ABC correction once we start moving back up again and we confirm that the downtrend is over. So I think at a minimum, we're going to need to get back through these two moving averages and the recent bounce that we saw, which got us back up to about 44.60, 44.70. We're going to have to get through that level before I would say that the ABC correction phase is over. So right now, I mean, with futures down this morning, or at least they were earlier, I mean, we could go lower. I'll be surprised if we go much lower, just because we're starting to turn the tide now. We're starting to head toward earnings. I think the market's going to anticipate strong earnings growth and raised forecasts again. And I just don't see the market going down in that environment. Maybe we don't break out. Maybe we go back up and test the highs and then get through earnings season and then continue to consolidate. But my guess would be that we're going to see another breakout. And I think it's going to come in the next 4 to 6 weeks. And that would historically set up. That's the way the market tends to do. October is good. November is very strong. Tends to be a very strong month for U.S. equities. All right, so that's the ABC correction. Now, you might say, well, why aren't you more bearish? There's lots of bearish things going on, and there's a lot of news out there that is bearish. That much I'll say. I mean, I remember back into the 1980s, there was just so much talk about debt, that we have too much debt. We have too much debt. That's always the go-to. I mean, one thing I would argue against that is when rates are this low, debt is cheap. It's very easy to continue to make your interest payments when interest rates are so low. I don't worry about debt when interest rates are at the yield's at 1.5%. I just don't. The government can borrow very, very inexpensively, which is great. I mean, think about when you want to fix up your home, or if you want to buy a home. They talk about that affordability index. You can buy a lot more home when interest rates are where they are now than when rates go, moving back up again. Or think back, even when I bought my first home, I think it was back in the late 1980s, interest rates were almost 10%. My mortgage, I couldn't afford, anything. Barely could afford to get into a townhouse I had back then. But now with rates so low, it's so cheap. I mean, a lot of times houses, it's cheaper than to rent. Assuming you have the credit and the availability to buy, makes a lot more sense. But anyway, I just believe that the low interest rates are conducive to government borrowing. I don't even think about it. I mean, yeah, at some point rates go skyrocketing, it's going to be a problem. And you know what? Stock market's going to reflect that. But why are we worrying about it now when rates are at historic lows? That's just a topic for people who just want to continually be bearish about the market, because we always have debt. Debt continually goes up. Oh, it's never been this high. Well, 5 years ago, it was never that high. 10 years ago, it was never that high. 40 years ago, it was never that high. It's always going up. It's, housing prices keep going up. So debt on homes is always going to continue to go higher. I mean, it's just, everything goes up over time. Anyway, I don't want to hash that in, but there's so many stories out there, so much negativity that, so the question is, well, why couldn't we go down? Well, we could. I'm not saying we can't go down. When I talk about the market, I talk in terms of probabilities, odds, managing risk. I'm not talking about guarantees. I've never guaranteed anyone or talked at any time about the market absolutely guaranteeing it going higher. That's not going to happen. But I believe it's going higher. One of the things that makes me think it's going higher is when we look at the relative strength of the sectors versus the benchmark S&P 500. Wall Street is not dumb. They are very, very smart. And they see things coming before we see things coming. And, they've got their economic advisors, with their MBAs and PhDs. And I mean, they know their stuff. And the only way to really know what they know is to follow the charts. That's the only way I know to know truly what they know, is to follow what they're buying and what they're selling. Where's the relative strength? I can tell you that not many bear markets start with technology at all-time highs relative to the S&P 500, which is where we were just a week ago. You know, and you look at consumer discretionary. Actually, let me back up here. Let's go look at consumer discretionary and say, well, consumer discretionary is going down, so that's a bad thing. Well, look at how much it went up from March through through September of last year. I mean, it skyrocketed. So it's like anything else. If you go up 100%, it's okay to come back 30%. It's still an uptrend, higher high, higher low at this point. And I want to use this chart. I'm going to go back 20 years. I want to show you, keep in mind that consumer spending is 2/3 of our economy. 2/3 consumer spending. Now, back in 2007, 2003 to 2007, we had that, it was a cyclical bull market within a secular bear market. Look at consumer discretionary. Coming out of the bear market, 2002 did very well. We continued pushing higher until the beginning of 2005. Now, if you look from 2005 to 2007, right here, early October 2007, that's when the stock market topped. Consumer discretionary was near a 5-year relative low. Wall Street was getting out of consumer discretionary stocks while the S&P 500 was sitting at an all-time high. So if you're just looking at the indexes, you don't really see what's going on in the market. Now I want you to take a look at what consumer discretionary has been doing since we broke out in 2013 into what I believe is the current secular bull market. 2013, if you're wondering what the magic is of that year, that date, that was when we finally cleared the 2007 high and the 2000, let me just pull up the S&P 500, and the 2000 high. So if we go here, and I'll go back 25 years. So there you go. There's that double top. So this was all secular bear market. Now, to me, the bull market doesn't start until you get the breakout. Who's to say we don't go up here, test the highs, and roll right back down again? I mean, if you remember all the news back then, you know, the banks failing and the TARP and the QE coming out, all those things, there was plenty of news to suggest that there was no way we were going to break out the new all-time highs. Who could think that? But we did. And that's why you have to pay attention to the charts more than the stories in the news. But at that time, that's when we broke out. It was April of 2013, April 10th, 2013. We broke out, took out that double top. And that's when this new secular bull market was born, in my opinion. So yeah, the lows were 2009. And if you were, you know, if you had a crystal ball, I mean, I don't know too many people that were screaming in 2009 that we were starting a 20-year bull market. You know, nobody hands out, you know, signs or whatever telling you when that's going to take place. But anyways, you look at this consumer discretionary. Oh, let me go back one more. So if you look at consumer discretionary, I mean, you can see it's been trending higher. I mean, if I was going to annotate, if something, you know, just looked really, you know, started to look kind of crazy to me, it might be if we, you know, were to lose maybe that trend line or the recent breakout down here. You know, we broke out, we never went back really and tested that. I think if the market were to get really weak and have, say, a 10% correction, I don't think we're going to get one, but you never know. If we did, the XLY versus the S&P 500, I'd start to grow much more concerned if we lost the trend line plus this area of relative price support. But I'd be surprised. So anyway, you know, these are just some of the signs where I look at some of the more aggressive areas of the market. And if I don't think that they're looking bad historically, you know, and looking back over history, I'm not going to grow bearish the market because Wall Street is not getting out of these stocks. Wall Street's continuing to own these stocks. And so let me pull up, for instance, we'll go back to that XLK and give you the last 20 years. I mean, look at this. If you really believed we're going into a bear market, would you be bidding up technology shares like this? I don't think so. This is the high growth area of the market. So I just, I think a lot of it's, a lot of the news stories are way overhyped. Just follow the charts, follow the charts. All right, last thing I wanted to show you, and I'll pull this up on a long-term weekly chart as well. Let's take a look at the crude oil prices. So your crude oil prices, this is the area that I was talking about on crude oil, where 2018 we got up to, I think if we, well, this is a weekly, I think if we did a daily, probably see it going up just a little higher. Yeah, like right here, I think maybe we got to about 77. See if we can find the high here. Well, it's saying 75.91. Let me shorten the chart so we can, let's just go back the last 7 years. So there's your crude oil, 75.91. I was thinking it was a little bit, I was thinking 76, 78, or 77. But anyway, 75.91. So we're right there. I mean, 75.88 is where we closed on Friday. So I think you can see this is a pretty significant top on crude oil. So if you're a fan of energy and you're looking at trading the XLE, and for the most part, I'm not. I'm fine when it's trending higher. I just look at the big picture. And if I'm worried about the dollar, if I think the dollar is going to go higher, then the tendency for crude oil, it's not that it can't go up. It's just that, or that the XLE can't go up. It's just it's the relative performance that I'm worried about. So when I talk about the dollar going up, I'm just worried about the XLE underperforming the S&P 500. Not that it won't go up or can't go up. Even if we get this breakout in crude oil, if the dollar strengthens, I'm not going to be looking for the XLE to be a long-term outperformer. But if we get this breakout and the dollar's not moving higher and the XLE can then break above, let me pull that chart up. You look at the XLE and look at these highs right in here, 55, 56. Then just, 4 or 5 months ago, we were back at that 55 level, and here we are now at 53, almost 54. So yeah, this is an area that we've got to pay attention to. This is where sellers have come in on the XLE. So while the S&P 500 has been going up and setting records left and right for the last handful of years, since 2013, look at what the XLE's done. It's gone nowhere. So short term, you want to trade it? Great. Long term, if the dollar remains in an uptrend, I personally would not be a fan of the group, and I'm going to stay away from it. All right, just a couple of earnings coming up later this week. Let's talk about those. So we got Pepsi, and I'll put that up on a relative chart here. So Pepsi comes out. I actually like this chart right in here. I think Pepsi's at a pretty good support area. You can see from July when they reported, they gapped up, and we've come back and we've tested that area. So we got an uptrend. We're in a secular bull market. We're testing gap support. I would expect to see Pepsi go higher. I mean, it's not going to be one of my favorite picks. It's not been a great performer relative to the S&P, that sort of thing. But I think within the soft drink group, it's not a bad stock. We'll see how earnings come out. Another one that'll be out, and also in the consumer staples area, Constellation Brands. Now, this one's been trending down for a while. We got these recent lows at 210, and you can see these lows came in right at about 210 or just below 210. So like Pepsi, this one's at a pretty key support area as well, but it's been trending down for a while. It doesn't look like it's going to have blowout earnings based on how it's trading. One other one that I'll just point out, Levi will be reporting later this week. This is in the clothing area. And this is another one down near key support area at about 24. And then it's got this other support, maybe 22, 23. But it's been downtrending after putting in roughly a double top. 80 line's been coming down. So I think there are others that are better. But all three of these stocks are down near support level. It's going to be interesting earnings week just with those three. All right, the three you must see to wrap up for today. I'm going to give you three stocks here that are kind of doing some opposite stuff. So SGen, which is CGen, just making a breakout on increasing volume, taking out this double top here. So I would expect this stock, outside of maybe a possible 20-day test, look at that AD line too, by the way. I would think the stock's going higher. I'd be looking for it to move up into that 190, 200 area to test the prior highs. Next up, ILMN. This is Illumina. This is also biotech. This one's been heading in the other direction, moving lower. But look at these lows down here. I'm going to say this low from 360 up to 370 on these two lows. Stock's been going down. If I look, for a support or an area where it may turn, I'd be looking down around 360, 370. Last one I have for you, HOLX. This is Hologic. Now this one, I just wanted to show you the character change on a chart. This one's trending higher, it's moving up, pulls back, moves up, kind of goes sideways, moves up again. I'm going to put it on to a different chart so you can see the PPO. So here's your PPO up here. See on this last high, lower PPO, negative divergence. Then we see the selling come in, the failures at the 20-day moving average, and then we keep moving lower. The PPO goes negative. Now we've got a negative configuration. So here, I like trading a stock on the long side when the momentum is strong and strengthening. But when it's coming down, I try to ignore it until either I see a positive divergence or I see a break above moving averages, something. Because right now, this one looks like a short-term bearish chart. All right, that's it. I did run a minute into the market. Let's see what we're doing here, and then we'll wrap it up. Currently, NASDAQ down 75, Dow down 38, S&P down 9. So we are seeing a little bit of negative action here at the open. But that's it for me. I'll be back tomorrow with a recorded version of Trading Places Live. You can watch it at Stock Charts TV. Just come in here at 9 o'clock tomorrow morning, Eastern time, and click on the Stock Charts TV and you'll catch it. Everybody have a great day, and hopefully we'll see you tomorrow. Happy trading.